Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hi, this is Dr. Bryan Taylor, Chief Economist at Global Financial Data. Global Financial Data delivers more than just an alpha edge with our unabridged Chainlink series spanning centuries. Our data drives breakthrough insights and unrivaled results for today's top analysts, offering a level of depth and accuracy unavailable anywhere else. Empower your algorithms with the rare, proprietary data only GFD can provide. To learn more about us, visit globalfinancialdata.com. 200 years of market concentration in the United States. Investors have noticed the increasing concentration of companies at the top of the stock market in the United States. During the past 10 years, the top 10 stocks, the supercap companies, have doubled their share of the S&P 500. The big are getting bigger, and the small are growing at a slower rate. This is because the largest companies in the U.S. stock market, the supercaps, Apple, Microsoft, Alphabet, NVIDIA, Amazon, and Meta, all now trillion-dollar companies, have grown faster than the mid-cap and small-cap companies during the past 10 years. As technology has spread worldwide and new information technology and biotechnology discoveries have been made and implemented, the supercap companies are better able to take advantage of these advances than smaller companies. The supercaps can buy up or invest in smaller companies before they even go public. Consequently, the U.S. stock market has become more concentrated, not less. And the U.S. stock market has outperformed the rest of the world. Currently, all but 4 of the top 25 companies in the world are American companies. Is this trend an anomaly or part of an ongoing pattern in the stock market? To answer this question, we've collected data on the concentration of the U.S. stock market over the past 235 years, from 1790 until the present. We have broken down the market concentration in the United States during the past 235 years into 7 periods. 1790 to 1840, the Bank of the United States dominates. 1840 to 1875, the rise of the railroads. 1875 to 1929, the American Commercial Revolution. 1929 to 1964, the first Magnificent Seven. 1964 to 1993, free trade leads to global expansion. 1993 to 2014, the rise and fall of the stock market. 2014 to present, technology stocks take over. Concentration in the U.S. stock market has alternated between periods of greater concentration and less concentration. Concentration generally increased during bull markets and decreased during bear markets. Concentration fell during the periods from 1790 to 1840, 1875 to 1929, and 1964 to 1993, when new industries played a greater role in the stock market. Concentration increased during the periods from 1840 to 1875, 1925 to 1964, and since 2014, when 1 or 2 industries and a smaller number of firms increase their domination of the stock market. We will analyze each of these periods now. 1790 to 1840, the Bank of the United States dominates. Between 1790 and 1840, the first Bank of the United States and the second Bank of the United States were the largest corporations in America. During those 50 years, new companies, mainly banks and insurance companies, issued shares and gradually reduced the Bank of the United States' share of market capitalization. The market cap of the first Bank of the United States was $14.8 million in 1791 and $9.9 million in 1814. But its share of the U.S. stock market declined from 85% to 16% as the number of companies listed in the United States grew from 4 to 68. Full shares in the Second Bank of the United States began trading in 1817, and its market cap was $54 million, or 48% of the U.S. stock market. But over time, more companies listed in the United States. By 1838, the market cap of the Second Bank of the United States was $48 million, but its share of the market cap had dropped to 15% as the number of companies listed in the United States increased to 311. Until the 1830s, finance stocks represented over 90% of the total market capitalization of the United States. In the 1830s, railroads were built across the country and reduced the share of finance companies in market capitalization. 1840 to 1875, the rise of the railroads. During the 1840s, railroads began to dominate the U.S. stock market. In 1845, the Vermont Central Railroad was the largest corporation in the United States, and a transportation company remained the largest company in the United States until Standard Oil took the title in 1884. The creation of the New York Central Railroad, the Pennsylvania Central Railroad, the Chicago Rock Island Pacific Railway, and other railroads that connected Chicago to the rest of the nation in the 1950s created a new concentration of stocks based upon railroads. By the end of the Civil War, all of the 10 largest companies in the United States were related to transportation. The 10 largest companies represented 20% of the stock market in 1853 and stayed above 20% for most years up until 1911. After the Civil War ended, the United States built railroads throughout the country to link the nation together. The Transcontinental Railroad was built between 1863 and 1869 and linked the Atlantic to the Pacific. However, the railroad enabled new industries to come into existence, which used the railroad to reach their customers. The telegraph, telephone, typewriter, and other new products created new industries that didn't exist before. Western Union began trading in 1864, American Express in 1866, and the Pullman Palace Car Company in 1870. The number of stocks grew dramatically after the Civil War ended, rising from 267 in 1865 to 676 in 1875. 1875 to 1929, the American Commercial Revolution. When the Civil War was over and railroads now reached every city in the United States, new industries were able to quickly spread throughout the country. Electricity enabled new industries to be introduced, especially in consumer goods. Electric utilities were established in every city in the country. The number of stocks covered by global financial data grew from 676 in 1875 to 2,097 in 1895. Sewing machines, department stores, meat packers, leather companies, ice companies, typewriters, photography, mail order, automobiles, radios, and dozens of other new industries expanded the sectors that served America. The concentration in the United States stock market actually increased between 1892 and 1903 as trusts tried to dominate individual industries, but antitrust suits broke up American Tobacco and Standard Oil and put other industries on notice not to limit competition. By 1900, Standard Oil represented 9% of the U.S. stock market, and the top 10 companies 24%. General Electric went public in 1892, Eastman Kodak in 1896, American Telephone and Telegraph in 1900, U.S. Steel in 1901, Sears in 1906, General Motors in 1909, IBM and Woolworths in 1911, DuPont in 1915, and RCA in 1919. After Standard Oil was broken up in 1911, 34 oil companies were spun off. Standard Oil of New Jersey, California, New York, and Indiana were each among the 10 largest companies in the United States during the 1920s. The addition of the coverage of banks and other stocks on regional exchanges in 1894 boosted the number of stocks covered by global financial data to 2,000 in 1895. By 1928, the expansion of all these industries, the growth of regional stock exchanges, and new interest in the stock market increased the number of companies to 3,825. Consequently, the concentration of the U.S. stock market declined between 1900 and 1929. In 1929, the largest company, American Telephone and Telegraph, represented only 3% of the stock market, the top 5 10%, and the top 10 16%. In 1900, those ratios had been 9%, 17%, and 24% respectively. However, in 1929, the stock market crashed, and over the next 4 years, the number of companies fell by 40%, and the concentration of the stock market began to increase once again. 1929 to 1964, the first Magnificent Seven. The wild expansion of the 1920s was followed by the relative stability of the next 3 decades. Between 1928 and 1933, the number of companies that were listed on the stock market fell from 3,825 to 2,327, a 40% decline. With fewer companies, the concentration of the stock market increased. While there was a gradual decline in the concentration of companies in the United States between 1875 and 1929, the stock market became more concentrated between 1929 and 1964. Between 1933 and 1964, there was relatively little change in the stock market. The number of companies on the New York, American, and regional stock exchanges remained around 2,300 during those 3 decades. Before 1929, the government tried to keep its role in the economy to a minimum and allow the market to allocate resources. After the election of Franklin Roosevelt in 1932, the government intervened directly in the economy to try and avoid another Great Depression. The government ran the economy during World War II and directed the economy after the war was over with. American Telephone and Telegraph, General Motors, IBM, Standard Oil, General Electric, DuPont, and U.S. Steel were the Magnificent Seven of the 1930s, 1940s, and 1950s. Those 7 companies remained among the 10 largest companies during most of those 3 decades. Their position among the largest companies might change, but those 7 companies dominated the American stock market. This occurred despite the highest returns in the history of the American stock market after World War II. 1964 to 1993, free trade leads to global expansion. 3 decades of rapid change began around 1964. Just as there had been rapid industrial innovation between 1900 and 1930, there was rapid industrial innovation between 1964 and 2000. Computers, the internet, software, semiconductors, healthcare, and other technology industries grew dramatically as science discovered new products to deliver to customers. And it wasn't only in technology that the stock market was transformed. Companies like McDonald's, Disney, Walmart, and hundreds of others discovered both new products and new services to provide to Americans. The 1960s was the era of the Nifty 50, when supposedly you could put your money in any of the top 50 stocks and go on vacation. Then, in the 1970s, the energy crisis hit, and energy companies grew at the expense of the rest of the economy. Stagflation prevented the economy and the stock market from growing. Many of the Nifty 50 stocks collapsed in price as the price of oil increased tenfold. In 1980, 6 of the top 10 companies by market cap were oil companies, while in 1972, only 2 oil companies had been in the top 10. In 1984, American Telephone and Telegraph was broken up into Ma Bell and the Baby Bells. IBM lost its position as the largest company in the United States in 1989 to ExxonMobil, but Intel and Microsoft were soon part of the top 10 companies. The number of companies that are covered by global financial data increased from 2,367 in 1960 to 8,513 in 1996. The share of the largest, 5 largest, and 10 largest companies fell from 7%, 18%, and 24% in 1960 to 2%, 7.5%, and 12% in 1995. The internet and the personal computer replaced the mainframe computer, and mobile phones took the place of landlines. Long-distance calls were placed through satellites and not the operator. By 1993, the growth of all these new industries reduced the concentration in the American stock market to the lowest level in its history. 1993 to 2014, the rise and fall of the stock market. 150 years ago, the top 10 stocks represented about 30% of the top 500 stocks by capitalization. This fell to 22% in 1894, rose back to 29% in 1903, then plunged to 17% in 1925. Concentration generally decreased between 1875 and 1925. The market became more concentrated for the next 40 years, peaking in 1963 to 64 at 32%. Then concentration declined until 1993, when it fell below 16% to its lowest level in history. Concentration increased during the internet bubble of the 1990s, reaching 24% in 2001, then fell back again, hitting a new low of 16% in 2014. The period from 1993 to 2014 was a period of large increase in the concentration of stocks in the United States. Internet and computer stocks enabled a small number of tech companies to move into the top 10. Microsoft, IBM, Intel, and Cisco Systems were among the 10 largest companies in the United States, while Pfizer and Merck were biotech companies in the top 10. However, in 2008, Microsoft was the only technology company that remained in the top 10. Apple joined the top 10 in 2009, and by 2012, it was the largest corporation in the world. 2014 to the present, technology stocks take over. Since 2014, Apple and Microsoft have been two of the largest corporations in the world. The share of the top 10 stocks to the top 500 doubled from 16% in 2014 to 35% in 2024. Analysts have noted the increased concentration in the stock market during the past 10 years. In 2014, there were only 2 technology stocks in the top 10. In April 2024, the only 2 companies that were not technology stocks were Berkshire Hathaway, which has 40% of its portfolio in Apple stock, and Eli Lilly, which is a biotech company benefiting from the success of its weight loss drugs, Mounjaro and Zepbound. Whether analysts are talking about the FANG stocks or the Magnificent Seven, they're focusing on a handful of stocks whose market capitalization is now over $1 trillion each. Apple reached $1 trillion in capitalization in August 2018, $2 trillion in August 2020, and $3 trillion in June 2023. It was 100 years ago when the market capitalization of a company first reached $1 billion. Will a company be worth $1 quadrillion 100 years from now? Our descendants will have to answer that question for us. If you look at the historical pattern, you'll see increases in market concentration in the late 1920s, after World War II, and during the late 1990s. Each of these was accompanied by a bull market, which was led by a few large stocks. However, when a bear market followed, the concentration declined. In each case, most of the increase in concentration was eliminated during the subsequent bear market. It's only been since 2014 that concentration has increased dramatically. This would lead us to believe that even when the next bear market occurs and concentration is reduced, not all of the increased concentration will be eliminated. The overall trend may be for growth and greater concentration for years to come. Conclusion. Analysts have noted the increasing market concentration that has occurred during the past 10 years. 6 companies now have market caps over $1 trillion, and that number is likely to grow. The question is, how long will increased market concentration continue? The stock market has become increasingly concentrated during the past 10 years as tech stocks have benefited from new technological innovations more than smaller companies. Large cap stocks have outperformed small caps, and the U.S. stock market has outperformed the rest of the world. A new group of super caps now dominates the market. Based upon our analysis of the past 150 years, there seems no reason to believe that the increased concentration of the past 10 years is the harbinger of a major bear market. Increased concentration is the sign of a bull market, and bear markets reduce concentration. There have already been 2 bear markets during this decade, in 2020 and in 2022, but each one was mild and brief, so there was little impact on concentration. Neither one was like the bear markets of 2000 and 2008, in which the market declined by over 50%, each of which reduced concentration. As long as new technological innovations continue to occur, the trend in increased concentration will probably continue. In the past, sudden increases in the market concentration were not followed by dramatic bear markets. Bull markets continued for years following the concentration that was associated with the onset of a bull market. The introduction of AI will probably aid the increased concentration in the stock market, benefiting the super caps. We may not be able to predict the future, but as the saying goes, the trend is your friend. And for the near future, the trend is for greater concentration. There is little reason to believe that a new bear market is imminent as a result of increased concentration in the market.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to The Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.